Well, new at 5, as gas prices continue to skyrocket, those filling up the most aren't shying away from the road. Over the pandemic, while many businesses took massive hits in sales.
Nobody saw this coming. 12 of America's biggest RV dealerships are quietly collapsing. Stores closed, lots empty, and the discounts you're seeing online aren't sales, they're survival. After years of overexpansion and easy credit, the bubble just popped. And what's next could change how every RV owner buys, sells, or trades in 2025. Before you walk into a mega sale, you need to hear who's really going under and what it means for your wallet. Let's get into the list. General RV Center, the empire that grew too fast. They called it the largest family-run RV dealer in the nation, an empire built on optimism and asphalt. But optimism does not pay 8% interest forever. When demand collapsed, General RV's expansion turned from pride into pressure. Each new lot became a liability. Each unsold rig became a loan that would not sleep. Records from the Ohio Division of State Filings show that 2 branches, one in North Canton and another in Pennsylvania's Lehigh Valley, closed after a sales drop of 28%. That is not a slow decline. That is a wall. For every motorhome left on the lot, roughly $1,070 in monthly financing kept ticking away. Multiply that by nearly 2,400 units nationwide, and you start to see the bleed rate. Dealers call it floor plan stress. In plain words, it means the bank owns more of the inventory than the business does. The longer it sits, the faster the interest burns through the margin. What once looked like growth now reads like overreach. Inside, sources leaked a memo referencing operational consolidation. Translation: shutting doors quietly before lenders force the issue. Customers arriving for service found gates chained, phones unanswered. Prices have fallen from $139,000 and $900,000 to $92,500 within weeks. That is not a discount. It is triage. And if a proud family network like this cannot survive its own success, imagine what happens next to the corporations still pretending everything is fine. Camping World, the retail titan, retreats. Once, its billboard stretched from highway to horizon. Camping World was the giant that promised scale would protect it. But scale has a cost, and the bill finally arrived. When the market cooled, the empire that grew on borrowed momentum started folding its own tent. Recent filings confirmed at least 14 store closures across 11 states. Locations in Oregon, New York, and North Carolina vanished from online listings within 1 week. On paper, it is called network optimization. In reality, it means lights out and locks changed. The problem hides in the math. Each dealership carries millions in floor plan loans. At 8% interest, every unsold fifth wheel or motor coach drains profit before it even finds a buyer. A single Class A tagged at $144,700 costs more than $1,200 a month just to keep financed. Multiply that by 300 units per store, and the wait becomes impossible. Wall Street once celebrated this brand's reach, 190 locations nationwide. Today, that reach has turned into a liability. Overhead, taxes, payroll, insurance, and now shrinking foot traffic all collide at once. Managers are instructed to clear lots aggressively. Translation: liquidation disguised as sales events. Discounts run deeper than ever, but they are meant to convert inventory into cash before creditors call the note. Shoppers see celebration banners. Insiders see surrender. And when the biggest retail name in the business starts cutting its own routes, smaller networks feel the tremor before the ground even moves. If you've seen dealerships near you cutting staff or closing their doors, drop a comment below and tell us where. Hit the like button if you want more real updates that show what's actually happening behind those gates. Bish's RV. Growth became gravity. Success can feel weightless until expansion pulls it back to earth. Bish's RV rode the pandemic boom like a rocket. They bought smaller dealers across Idaho, Montana, and Utah, convinced that demand would never fade. But what lifted them in 2021 now drags them down in 2025. State labor filings from Montana confirmed 2 locations closed with 47 employees laid off. The reason is written in plain numbers. Bish's purchased inventory at the height of the market when prices soared beyond logic. Now those same units sit unsold under new financing terms, nearly double their original rate. A fifth wheel listed at $98,300 costs more than $860 a month in interest alone. Multiply that across 2,100 rigs, and each sunrise burns away the margin. They are paying to store losses. Insiders describe inventory rotations meant to disguise stagnation, moving coaches between states to make lots appear active. Customers see motion. Accountants see debt on wheels. Discounts that once looked generous are now desperate. Tags reading "limited offer" hide the pressure of banks demanding payment before the quarter closes. Bish has called it strategic realignment. Workers called it what it was, a slowdown disguised as a plan. Still, this fall feels different. The confidence is gone from the sales floor. The smile costs too much to hold. And as Bish's balance sheet tilts, every regional dealer that copied its playbook suddenly feels that same pull toward the ground. Mesa RV. Sunshine can't save the desert lots. Beneath the bright Arizona sky, Mesa RV once looked untouchable. The company's slogan promised, "Experience life outdoors." For decades, that sunlight covered everything. The optimism, the profit, the risk. But when the heat rose on costs and the buyers thinned, the glare exposed what was underneath. Local records from Maricopa County show multiple facilities listed as permanently closed. Employees confirmed sudden shutdowns in Tucson, Mesa, and San Diego. Inside, sources said the decision came after a double hit: interest rates rising past 8%, and Class A motorhome demand collapsing by nearly 40% in 1 year. Sunshine does not pay interest. Each unsold luxury coach, priced near $312,500, costs about $1,900 every month in financing. Multiply that by hundreds and the math melts faster than the asphalt outside their showrooms. By the end of the last quarter, La Mesa's California division recorded a year-over-year revenue slide of 29%. Managers stopped ordering new inventory and began cutting staff quietly. Even their digital listings now show blank categories marked "Inventory Unavailable Buyers." Arriving for scheduled walkthroughs found locked gates and silence. One former employee said, "We were told to act positive until the final hour. That final hour came fast." Discounts still appear online, but the titles are already held by. The warmth of the brand's image is gone, replaced by the cold precision of foreclosure notices. And as the desert wind moves through empty lots, another Sunbelt giant feels the same heat closing in from the horizon. Brett's RV and Marine Mountain, margins evaporate. In Montana's high country, Brett's RV and Marine once stood as a landmark of confidence. The sign at the Missoula rose like a flag, proof that family ownership and open skies could still win. But this year, the mountain air turned thin. Margins vanished, and stability gave way to silence. Local tax filings confirm that 2 satellite locations, Helena and Nampa, were marked inactive at the end of the second quarter. Behind that paperwork lies a pattern repeated across the industry: financing that costs more than the inventory is worth. Each fifth wheel sitting at $96,700 burns roughly $890 in interest every month. Multiply that by 1,160 units, and the debt climbs faster than the snow line. Management called the closures seasonal restructuring. The crews called it what it was, an early winter. Even during peak travel months, foot traffic never returned to its pre-boom rhythm. Families that once drove hundreds of months to browse now scroll online and wait for liquidation tax. By autumn, Brett's began auctioning overstock quietly through third-party channels. One Class C model that listed for $121,200 sold for just $84,500. The loss was disguised as a promotion, but the math tells the truth. Now, as the last lot lights dim before snowfall, Brett's remains a warning written across the horizon. Growth is easy when the climb is gentle, but in the mountains, gravity always gets its turn. Funtown RV, the Texas Titan tightens. Under the wide Texas sky, Funtown RV built its reputation on volume and velocity. They filled fairgrounds with banners and brass bands, promising the largest selection in the Lone Star State. For a while, it worked. Sales soared and expansion followed. But what grows fastest often bends first. County tax records show 2 satellite stores, one in Waco and another near Conroe, officially vacated this quarter. The reason sits in plain sight. Floor plan debt swelling against thinning demand. Every towable unit priced at $78,400 costs nearly $720 a month just in interest. Multiply that by more than 2,800 pieces of stock, and the numbers begin to choke the balance sheet. Executives labeled the closures regional optimization. Employees said the trucks came before dawn. Inside, sources describe lenders tightening credit lines and demanding faster turn rates. That pressure turned promotions into liquidations. The sales flyers still shout, "Huge event," but the urgency is no longer marketing. It is math. One buyer in Fort Worth watched a model drop from $64,900 to $52,200 in 10 days. That is not negotiation. That is survival. For a business built on Texas confidence, the tone has changed. Staff whisper instead of cheer. Discounts appear before questions are asked, and as Funtown pulls its reach back toward Dallas, the lesson echoes beyond state lines. When speed becomes strategy, slowing down is the only move left. North Trail RV Center, luxury meets the wall. Naples, Florida built its name on sunlight, salt air, and confidence. North Trail RV Center fit that image perfectly. Rows of gleaming Class A motor coaches lined up like yachts on pavement. Buyers flew in from across the country just to walk those lots. But when luxury stops moving, even sunshine cannot hide the shadows. Insurance costs tripled after 2 hurricane seasons tore across the Gulf. Premiums that once averaged $680 a month per coach jumped beyond $2,040. Add in rising financing rates, and each unsold Tiffin Allegro or Newmar Dutch Star turned into a 6-figure anchor. County lease data confirms one showroom closure off Interstate 75, quietly labeled property transfer. Insiders admit it was a cost-cutting retreat. One salesperson described it simply: "We went from waiting lists to waiting rooms." Inventory sheets show a $144,900 coach discounted to $94,700 within 12 weeks. The markdown looked generous, but it barely covered loan interest. Even premium clients began holding back, nervous about warranty coverage if another branch fell. Behind the glass, morale eroded. Staff cuts spread through the service bay first, then through the sales floor. The espresso machine still runs, but the laughter is gone. North Trail once represented the comfort of certainty. Today, it represents the cost of excess, and as the last luxury rigs roll toward auction, the question becomes clear. If this is what happens at the top, what chance does anyone below have left? Lazy Days RV, public-private crisis. On paper, being public was supposed to make Lazy Days unstoppable. Investors called it the perfect storm of lifestyle and leverage. But when easy money dried up, the spotlight that once made it shine now shows every crack. The numbers no longer hide behind enthusiasm. They bleed in real time. In its most recent Securities and Exchange Commission filing, Lazy Days reported a net loss of $19 million for the quarter. Revenue slipped 15%, and operating costs climbed faster than sales could recover. What started as aggressive expansion has turned into an expensive retreat. At its peak, the company owned dealerships across 5 states. This year, 3 of them, Minnesota, Colorado, and Florida's East Corridor, were either sold off or closed entirely. Each property represented millions in floor plan loans now being reconciled at steep discounts. A Tiffin Phaeton once listed at $217,400 dropped to $169,800 before moving off the lot. The markdown looks generous. The balance sheet says otherwise. When your stock trades below $1, liquidation is not a choice. It is survival. Executives framed the contraction as strategic simplification. Employees described it as panic with paperwork. Some service centers went dark overnight, leaving owners unsure where to take warranty claims. For a brand built on confidence, silence now fills the showrooms. Investors wait for rescue, customers wait for clarity, and the market waits for the next headline. Because when a public company starts hiding behind private language, the reckoning has already begun. If you want the full story as this collapse unfolds, hit subscribe and stay connected. We track every closure, every markdown, and every new filing as it happens.